Wow, the Nasdaq is going cray-cray. Look at this. Bitcoins, is it going to follow? Where is the market headed? Where is the market going? So much happening right now because they have just lifted the debt ceiling in the United States. In principle, although there can still be shenanigans that can happen, but essentially we think the debt ceiling is probably a drama that's in the rear window now. So what's going to happen next? This is going to be a very action-packed couple of weeks coming up. This is Pablo at Treasure Island. Are you ready? Here we go. So basically, they've just lifted the debt ceiling. And what that means is basically this. The debt ceiling is basically how much the United States government can borrow. Now, this is the US Treasury General account, right? It's kind of like saying it's your personal account of how much money you have for the US government. And this is, at its peak, it had something like $1.8 trillion in there. And then they push it down to zero, right? They lift the debt ceiling, it comes back up again to almost $1 billion there, and then it's back to almost zero again. And they've just lifted the debt ceiling. Why are they saying, there would be a default? It's because imagine that the US Treasury General account like this. It's basically, there's always money coming in and there's always money going out. But it can never be zero, because when it's zero, then the US government stops paying its bills. Either it stops repaying interest on borrowers like China or Saudi Arabia or Japan, who borrows money from the United States, or it stops paying Social Security, US military, or education, teachers' wages, or whatever it is, or government employees. So in the US Treasury account, you've always got money coming in through the form of taxation. That's the only time the US government makes money, pretty much. And then at other times, there's always money being paid out as well. It's just like your own personal checking account. You've got wages coming in, right? And you've got passive income coming in, but you also have to make payments that are going out. It could be anything. Could be your Netflix subscription, could be your electricity bills, could be your paying for a car, paying for fuel. Well, that's kind of like how the US government works as well. It's basically money coming in all the time and money going out. And for the last few weeks, we've gotten very close to zero, as we can see on that chart. However, what happens is now they've lifted the debt ceiling. So that means a lot more money can come in now. That means the US government can borrow again. And that's not necessarily good news. Let me walk you through what that means. So basically, let's have a look at this. In early January or last week of December, they started, selling treasury bonds again. That's the main way the US government raises money. And when they do raise money, they basically sell treasury bonds. So a lot of money comes into the US government's account. When it's inside the US government's account, then it's not inside the economy, right? So from, say, December to, all the way to May, July, September, right? A lot of money was coming into the US government account until it started going out again significantly. So what happened to the markets in that time? We'll have a look. Starting in December 2022. Here's December 2022, right? We're right at the peak of the Nasdaq, and then went all the way down and bottomed around October, right? And then a huge bounce up. Why was there a huge bounce up? Well, let's have a look. That's because around October, right, no more money was coming in, and yet all that money, how much was it? Around $600 billion was just being pushed out into the economy. That is what I call no QT. Basically, it counters what the Fed is doing. So keep in mind this: the Fed, through QE, quantitative easing, is basically buying bonds. That means they're taking bonds from the market and buying them, which means cash goes out into the markets, right? Into the banking system, into the financial system. More money in the financial system, the more stocks or crypto or houses, any assets, or even NFTs or collectibles, watches, gold would go up. When they do QT, quantitative tightening, which is the opposite, they sell bonds. So they have this piece of paper from the US government, they sell it into the market, and the market gives the Federal Reserve the money, so they take the money out of the financial system. That's how they do it. And now you can see the US Treasury also has the same thing. When they are selling Treasury bonds, when they lift the debt ceiling, that's what's going to happen next. Then money is coming in. Money is coming into the Treasury, into the US Treasury account, right? So money coming in means money leaving the economy, money leaving the markets in the US. And that's why the markets we saw just tanked. And then when they did the opposite, when they couldn't sell any more Treasury bonds because they hit their borrowing limit, that's what the debt ceiling is, then they could, then basically no more money going into US Treasury account, $600 billion come out of the US Treasury account, and it went back into the economy, back into the markets. So what that means is basically that is countering the effects of QT. In other words, whenever there's lots of cash or funds or money coming back into the economy, back into the markets, it tends to lift it up, right? That's a very simple concept to understand. So this is what happened last time when they lifted the US debt limit, right? What we saw was lots of selling of Treasury bonds, right? And for a number of months, US stock market crashed. That's because both the US Treasury and both the US Federal Reserve were selling bonds during this time. But does this always happen? So let's have a look at this period, right? This period is from, say, March 11th, 2020 to, say, January 2021. During this period, there was massive increase in the TGA or Treasury General Account. So a lot of money going into the Treasury General Account. Then by that measure, if lots of money is going into the Treasury General Account, not much money will be left in the economy or in the stock market. If that is the case, then shouldn't the market crash as well? Let's have a look what happened between, say, March 2020 to January 2021. Okay, let's have a look. Here's March 2020, right? March 2020 by January 2021, right? Let's say January 2021. It was a massive bull market. So how come it didn't work this time? How come the markets didn't go down this time, even though the Treasury General Account went up so much this time? Well, that's because, as I said, we don't just look at the Treasury General Account. We also look at the balance sheet of the Federal Reserve. So basically, this is the Federal Reserve, and it shows, QT or QE, and clearly, since March, where's March? Since March of 2020, we saw a massive pump, right, of money into the government until, say, this is January 2021, right? You had this massive pump, right? It went from 4 trillion to about 7 trillion. So $3 trillion were pumped into the economy, pumped into the markets, and then you had where is the here. You had the Treasury General Account take about, say, from 400 billion to 1.8 billion. So taking 1.4, the difference there is 1.4. Taking 1.4 billion of that, 1.4 trillion of that out of the markets. 3 trillion was pumped into the financial system, and then 1.4 was taken out, but eventually was pumped back in again, right? So I hope folks understand by now that mostly what we see happening in the markets, mostly, not always, is basically a function of how much money is the Federal Reserve and the Treasury pumping into the markets. Now, let's have a look at an even earlier period. Because this debt ceiling being lifted, also happened in 2011 and 2011, right, and also 2013. What happened to the markets then in 2011, 2013? Let's see. Okay, in 2011, here's 2011, right? It's basically, when the debt ceiling wasn't going to get passed, the markets were nervous all the way throughout August. But once the debt ceiling was passed, markets had a huge rebound, right? That's just been a massive bull market. And then in 2013 as well, 2013 basically was just being one massive bull run. So what happened there? How come the markets didn't crash in those two instances? Well, what actually happened there was this. It was due to, look at the Treasury General account. Rather than taking all that money into the Treasury General account, right? Taking all that money, they basically did it in very small moves. Say, have a look at 2011. They only took in 115 billion, run it back down low. Took in another 122 billion, run it back down low. They took another, 90 billion and run it back down to 13 billion. So they didn't take like 1 trillion, $1.4 trillion out of the market in one single hit. Let's look at 2013, right? 2013, same story. They basically, never took anything more than $150 billion out, and then they gave it back to the market. Took, $118 billion out and gave it back to the market. Whereas if I stretch it out, you can see the difference. See how before they were basically taking a little bit out of the market, giving it back, a little bit out, giving it back, a little bit out, giving it back. Now this time basically they took $1.7 trillion out of the $1.8 trillion out of the market, right? That period means the market, stock market, Bitcoin, crypto markets are missing $1.8 trillion. It went into the US Treasury General account. So that's why the markets, are in trouble, unless the Fed is doing QE. But the Fed is not doing QE right now. Here, we see the Treasury General account went from $104 billion all the way to $944 billion. So that's almost $1 trillion of difference, right? They raised almost $1 trillion from the economy. They took that out of the economy. That's why stocks and Bitcoin were in huge trouble in 2022. And also the Fed was taking out $95 billion per month as well. So in other words, how will the next few months be? I'm not expecting a massive crash because the Treasury, Janet Yellen, knows that this is happening, so she can crash the market. So I think she's going to go back to the 2011, 2013 style of basically raise a little bit of money, then spend it. Raise a little bit of money, then push it back into the economy. Raise a little bit of money, push it back into the economy, right? Because she knows the Fed is doing $95 billion of QT every single month, which is already taking a lot of money out of the markets. However, we can't be 100% sure. What if there's a repeat of what happened in 2022? We will only know how much money she's deciding to take out and how much she's pushing back out there, what kind of effect it'll have on the liquidity situation for the United States markets if we keep on staring at this chart. If we keep on following, right, this chart of the US Treasury General account and watch their announcements, then we'll know, right, next time when it bounces up, because now she can start printing again in a couple of weeks, she can start selling bonds again. Will it be a small bounce like this where they take out like $400 billion out of the market, or will they take $1.8 trillion out of the market? So that's why we have to watch this closely. Okay, so that means I don't have an instant answer for you guys. I've just told you guys what they have done in the past. And if we watch what they do with those charts, if we watch how much their bonds they're selling, they're taking out of the markets, then we know how the markets will react, and then we know how the next few months is going to shape up. So essentially, all we're doing is think of Bitcoin and think of stocks like boats out on the ocean, like these boats out on the ocean, and how much these boats float up or down depends on how much water there is in the ocean. So the question is, we're going to have to watch how much water they're pouring into or drawing out of the ocean. And that gives us a heads up, or one step or half a step ahead of the markets. Okay, this is Pablo Heyman. Thank you guys for following me. Follow me for more, and I'll update you all on where the markets are going.